Hello and welcome. In this video, we're going to tackle a fundamental question in accounting. When a company buys a long-term asset, like a piece of land, equipment, or even another company, what is its true cost? The answer lies in a critical concept called capitalization. The basic rule is simple. We record a long-term asset at its purchase price, plus all the costs necessary to get that asset ready for its intended use. This process is called capitalizing the cost. Instead of expensing the cost immediately, we record it on the balance sheet as an asset, which will be expensed over time through depreciation. Let's see how this works with different types of assets. First up, let's talk about land. When a company, like Olive Garden in this example, buys land, the cost isn't just the sticker price. We must also capitalize any cost needed to prepare it. Look at this breakdown. We start with the purchase price of $2.5 million. Then we add the real estate agent's commission, any back property taxes paid to clear the title, the cost of title insurance, and even the cost to remove an old building and level the land. Notice we subtract any money received from selling salvaged materials. All of these costs were necessary to get the land ready for building a new restaurant. So the total capitalized cost of the land is $3 million, not $2.5 million. The same principle applies to equipment. Assume a company buys new restaurant equipment for $82,000. Is that the full cost? Not quite. We must also add the sales tax, the cost to transport it, and shipping insurance during transit. We also include the $1,500 installation cost. All of these are one-time costs to get the equipment ready for use. So the total capitalized cost is $91,000. But look closely at this annual insurance of $1,600. Why isn't it included? Because it's a recurring cost that benefits the current period, not a cost to prepare the asset. Recurring costs like this are always expensed as they are incurred. Now, let's shift from assets we can touch, like land and equipment, to assets we can't, intangible assets. These include things like patents, copyrights, trademarks, and a very special one called goodwill. They have no physical substance, but they can be incredibly valuable. There's a crucial rule for intangibles. If a company purchases an intangible asset, like buying a patent from another inventor, it capitalizes the cost. But if a company develops an intangible asset internally, the costs are usually expensed immediately. Think about research and development. Under GAAP, all research and development costs are expensed as incurred. Why? Because it's very difficult to determine if and when future benefits will arise from that spending. The same goes for advertising costs used to build a brand. Finally, let's talk about goodwill. Goodwill is unique. It is only recorded when one company buys another company for more than the fair value of its identifiable net assets. Let's look at this example. Allied Foods pays $36 million to acquire Ritz Produce. The fair value of Ritz assets is $50 million, and its liabilities are $24 million. So, the fair value of its identifiable net assets is $26 million. So why did Allied pay $36 million for a company with net assets of only $26 million? They must believe there are other unrecorded benefits, like a great reputation, a strong customer base, or a talented workforce. This premium of $10 million is recorded as the intangible asset, goodwill. One last topic. What about costs incurred after an asset is already in use? The rule is, capitalize an expenditure if it increases the asset's future benefits. Expense it if it only maintains the asset for the current period. So routine repairs and maintenance, that's an expense. But a major overhaul that extends the life of an engine or an addition to a building, those are capitalized. So, to recap, we capitalize all costs necessary to get an asset ready for its intended use. This applies to tangible assets like land, buildings, and equipment. For intangibles, we capitalize purchase assets, but expense internally developed costs like research and development, and goodwill is only created in an acquisition.